Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
Kyle, welcome to the show. How are you?
I am doing great. Thanks a ton for having me here, Sarah.
I am excited. Tell us a little bit about yourself and how you got started in investing in real estate.
Yeah, it's a bit of a rabbit hole. Myself as I would call myself pretty, secure-minded, if that makes sense from a financial perspective. My primal question is, am I secure? That meant that I was kind of led down a path towards sort of certainty, So my parents were very, conservative investors, balanced funds. And, they lived a life that allowed them to still get to, a bit of a financial freedom goal for themselves to retire early. But they did in a very, I would say, traditional sort of mutual fund kind of way. And, nothing wrong with that. And for me, I was like, I want to do it a little bit better. So, I went down the rabbit hole of real estate. I really had always struggled with the idea of owning an asset that is really just an idea, paper, like owning parts, like really, really small parts of a company and it's supposedly being worth something. So I always fundamentally had a hard time with that. And whereas real estate, I was like, I know it's there. I know it's mine. And it's like to be able to just, go and knock on my own door was something that definitely fascinated me.
Yeah, I like the additional control as well. And I mean, some people might argue differently, but I think, you can control the cash flow, you can control when you sell it, you can control the refi. Like there's just, it's like your property and you're building an asset, like you said, versus a company. And I don't think it's bad to diversify, but like you, I'm heavily involved in real estate in terms of my portfolio as well. So when did you start?
I started back, I would say like when I started down the journey was pretty early on. I would, before going into university, I remember having this conversation and, this only came up recently in a conversation I was having with someone where I was like, totally forgot about this. And I would never have cited this as sort of my first thought, but I had a good friend and his parents had one investment property and it fascinated me at the time. And they were going to help their son, who was my friend at the time, to invest in a property. And I remember that being like a big thing for me. And I brought it to my parents and they were very, as you can imagine, they, very like, ooh, they're not used to it. They don't understand it. And they kind of shied me away from it. So I kind of put it to bed, went to university, came out, became a math teacher. I'm a math geek at heart. And at that time, that's when I started on a vacation, just kind of reading a book. And I don't even remember which one it was first that I read. So, I kind of feel bad about that. But I remember I was intrigued enough and eventually laid my hands on, Rich Dad, Poor Dad. And as a teacher, I was like one of the characters in a book, and I was like, oh, shoot, I'm going to be that guy. And I'm like, I don't want to be that guy. And, so that led me down the rabbit hole. And finally, that would have been probably 2008-ish when I was like reading these books. And finally in 2011, I had pulled the trigger on buying a property in the US. It was down in Florida, coming out of the, the great, the big housing bubble pop or burst.
Yeah.
And I went down there and I just took out a line of credit on my own home and went down and bought a place cash. I spent like over a year researching to try to find the right one and so forth. And that was my first, purchase. And then I kind of like hung out in the weeds for like a year. Like, is this really going to work? Everything I read, is it going to come true? And that led me down the path to, continuing to invest.
Very cool. So let's just, for example, let's fast forward. What is the strategy, your real estate investing strategy that you're mostly applying today?
I would say, we've tried, and I say I have a business partner, Matt Bigley. He's a realtor locally here in Windsor, Essex County. And we have tried many different things. We tried flips. I would say that both of us are not very handy. So we're open to say that you do not want to trust us with hammers or anything like that. So we've tried those, moderate success, but didn't enjoy it. I would say, we've tried, the BRRRR idea, But I would say for us, we call it a bit of a lazy strategy where we like to buy some properties that do have a little bit of sort of built-in margin of safety.
Mhm.
And it gives us the opportunity to potentially add some value to it. But we're not in any sort of real rush to then like run and get and refinance and pull the money out and then layer it back in. So we've always taken the strategy as sort of like a buy and hold with having some, we'll call it a little bit of meat on the bone right off the bat. So we aren't just going to the MLS and, buying properties. Typically it's usually something that, there's a special case, maybe it's off market, maybe it's an opportunity that falls in our lap. And, we really don't want investing to be our full-time job. We want investing to be something that's going to provide us, the lifestyle opportunities that we want, when we're ready for them.
Absolutely. So did you always have a partner as you were scaling, or did you and them become partners after a while?
Yeah, it was this. The story is actually really interesting and a bit of a, I don't believe in fate, but definitely universe. I believe in energy, and I believe in the universe kind of bringing different energy together. Because I had bought my first two properties back in 2011, 2012. The other one was in Arizona. And, then we were starting a family and we were starting to, things were getting busier and I couldn't keep up with the out of town investing as well as I'd like to. So I kind of went into a bit of a hibernation mode for a couple of years. And it was in about 2015 when I saw the sixplex come up just around the corner from my house. And I was like, oh, this is great. It was off market. It was, on Kijiji, it was online and you could tell it wasn't, the seller was just a mom and pop type thing. And I was like, man, but I was just sort of scared to pull the trigger. And, this thing was up there for a couple months. And then I was at work, I was teaching at the time. And, there was another teacher there and found out that they enjoy real estate investing too. His wife actually is, pretty popular on Instagram, the Leslie style. They would buy homes, renovate them while they're in them, make them beautiful, and then they'd, sell and move on to the next one. So they were doing a little bit of that. And he was eyeing up the same property. And, he sort of said, he's like, I don't know, like I've never done something like that, 6 units in one property, and we were like, why don't we team up, So that was sort of what began that journey together, just a random conversation at work one day. And he was eyeing up the same property I was. And I'm like, well, this, let's go in together, kind of, support one another, grow together, learn together. And, we've grown that portfolio ever since.
Very cool. So are you mostly then buying multifamily or are you still buying singles?
I would say whatever offers that margin of safety. We've really honed in. It's taken us a really long time to decide that there's certain things that we're better at or we feel more comfortable with. And then there's others that we just don't. And that's the one that we feel most comfortable. So if there's a property, if it's a single family home, we're not looking for single family, but if there is one, and let's say, there's a little bit of meat on the bone in terms of some equity that's going to be built in right off the bat, we'll go for it. If it's a 9-unit building, same deal, and the more creative we can be, the better. So we are really, keeping our eyes open for seller financing, things like that, just because it just makes the opportunity easier to be a win-win on both sides, because now we don't have the bank to deal with. We don't have other issues. It's just, you get to work with the seller. I really like to get to know, what does the seller want? Like, why are you selling? Not because I want to take advantage, but because I want to structure this in a way that's going to help you reach your goals. One seller, for example, wanted to just take the money. He had this building for 20 years and then he wanted to take the money and stuff it into a GIC. I'm like, what if I could give you something better than that? I'm like, what if you could secure it against the property that you've owned for 20 years and not have to manage it anymore because you just want to run off and do retirement? They're like, I would love that. I'm like, I'll give you a GIC rate on a mortgage. Let's go. And that deal ended up working.
Nice.
Whereas I don't think it would have had we gone for traditional financing. It just wouldn't make sense on our end. And then they just have this boatload of money that they then get taxed on and then have to roll into a GIC. So win-win on both sides. Everybody's happy. And, that was maybe 18 months ago. And that seller is loving the decision so far.
Now, is that in Ontario and Windsor, or is that in the US?
Yeah, you know what? After the first two properties, when I took that little bit of a hiatus, and then we started buying locally here, that began with that 6 unit property that we had purchased together, and then we just started, as I'm sure you know, and many others that have been on the show, as you start doing that, again, universe, whatever, people get to
Mhm.
know who you are, and all of a sudden you start having more opportunities. Certainly easier when you know the neighborhoods really well. So
Mhm.
you can tell very quickly whether it's, something you want to, look into and underwrite, or whether it's something that maybe just isn't your style. Whereas, the longer it's been since I invested in those first US properties, the more disconnected I feel. And I'm actually just starting to get back into looking in different areas, just because, as you know, I think a recent episode you had here was all about, the struggles in Ontario, right? With, landlord tenant board and all those wonderful things.
Mhm.
It certainly does start to make you think, what, looking elsewhere, in particular in the US, could definitely be something to get back into.
Yeah, no, absolutely. So you used to be a math teacher and you love math, and you mentioned, doing some underwriting and looking at deals. Can you share a little bit of like what your process is to, it sounds like you're buying under market. Like, do you have specific numbers that you run, or like a specific criteria that you're able to share that somebody can, potentially apply for themselves?
Sure, sure. Yeah, I would say for us, I've always been the number guy on, myself and my partner Matt. Matt is all about opportunity. So when the opportunity comes, he's like, "Hey, at a glance, it seems like it might be worth looking at. So we'll run it through." And ultimately, at the end of the day, for us, it's really about cash flow and that margin of safety. So, like, if there is, like, for us, even if it's cash flowing, but we don't feel like there's any sort of equity gain on the deal, we just recognize that as maybe an added risk that we may not be interested in taking on. I'm sure a lot of people can relate now, given, the past couple of years, as interest rates rise and as markets sort of faltered a little bit. That can be scary for some. Whereas for us, we sort of like to have, that knowledge that, hey, we own a good chunk of equity, even if some of that equity might be debt equity. We just want to make sure that we have assets that we can leverage in a pinch. So for us, a little bit of that, that equity in there is key for us. But then after that, it really comes down to cash flow, right? We don't want to be cash flow negative. We have never made any assumptions on appreciation. We look at that as sort of a bonus. And of course, as you can imagine, it has made it significantly more difficult over these past, COVID years to find properties, unless you're kind of landing on that off-market deal that, you don't have a bunch of people throwing in all these crazy offers for.
Mm-hmm. Yeah, for sure. So it's not like, do you have like a specific like percentage of equity that you want on the purchase, or it's kind of just deal by deal?
It definitely deal by deal. And I would say too, the nicer, or the, if the building is in better shape, we'll obviously, sort of lean off on that equity piece. If the building does need more work, typically that gives you an opportunity to potentially, gain more equity off the front end. So
Mhm.
while, nothing's perfect, hey, if we found like the perfect building and it was at market value and it cash flowed, we might still, decide to do that deal, as long as, again, that cash flow side's going to work. On the other hand, if the property has so much, equity available in it, or at least what we perceive to be equity available in it, that margin of safety is so great, even if it maybe isn't cash flowing, because we're not over leveraged in the other parts of our portfolio, we might take that on, and we might just look at that property as something as, hey, a value add that we can slowly improve and slowly lift, so that we can then get it to cash flow positive. So of course there's flexibility in there, but in
Mhm.
general, we like cash flow positive. We like margin of safety, but again, there's a little bit of a sliding scale. As you get more of one, you're probably losing from the other.
Yeah, right.
But we certainly don't want to just be buying a property because, we're FOMOing in and we just want to keep adding doors, where I think a lot of people kind of get stuck in that mentality sometimes. Like, I set a goal to be at this many doors, instead of thinking about, what is it that I really want, and what are the criteria that's going to make me confident in the number of doors that I do have in my portfolio.
Yeah. And we're seeing people with many, many doors. Unfortunately, some of them have, horrible stories right now where they're having to liquidate, or they're having to, figure out how to turn it around quite quickly. And we've all felt the pain, I think, in the last, couple years as rates were going, higher and higher. But the ones that already started with barely any cash flow or cash flow negative definitely felt it a lot more.
Totally.
So, the cash flow was a huge component to being able to, I think, just, keep what you had as the rates were getting higher and hanging in there for the last few years. What are some of the things that, you did with your portfolio? I mean, you've been investing, it sounds like, since 2011. I started in 2013, but, there's with the increases, there's definitely a loss of cash flow. There's likely some repositioning. There's likely some sales and some new acquisitions. But we've all had to make some shifts, right? I think as investors that were in the market. And I don't think that many people in the last couple of years can say that they've had, I mean, I'm sure there's an exception or two out there, but in general, most people have not had a great year in the last, I would say in 2023, mid 2022. It's been rough.
Yeah.
And so I guess if you don't mind sharing, what happened with your portfolio? How did you guys pivot? What are some of the things that you're doing moving forward?
Yeah. For us, and again, I feel blessed that we're in a position where we haven't relied on the cash flow for our personal lifestyle. So
Mhm.
right from the beginning, we began this journey thinking about this as more of a wealth creation tool that will eventually, provide us with the opportunity to do what we want, right? Which is great, but that was still maybe too general. So what we did, and maybe I'll speak about what we feel is maybe a mistake is probably too harsh a word, because there's many mistakes out there, but something that I think we would do again differently is that I think in our minds, we sort of got to this place of stacking doors and never wanting to give any up. Right. And that might be more me, kind of like, hey, give me, and a lot of people that have this number of doors on their mind. I want 10 doors. I want 100 doors. I want 1,000 doors. Sometimes I think that puts you in a position where you might have the blinders on. And I feel like as we saw the run up, while we weren't jumping into the frenzy to buy properties that were, being, overbid on and all of these things for investment purposes, while we stood on the sidelines there, what I would have done differently is I actually would have thought about, putting some of our properties up just to see what we can get, and then kind of repositioning, and then knowing that at some point, right, we're going to see a shift in that market. So of course there's risk there. Maybe this went on for 5 or 6 more years, and then you're watching, looking at your money sitting on the sideline. But we didn't do that. We just sort of held tight, and we kept looking for properties, kept underwriting, but we only picked up a very, very few properties that were in, very specific cases. So I would say that's something that I think we would change if we could. And now we're starting to recognize that, what, even though we would say we're primarily real estate investors, we have started to think about other ways that we can position some of our portfolio in a way that, might provide us with, call it like an opportunity fund that's available to us, or just to have a little bit more flexibility so that it's not all locked up in real estate. Because that's something that I'm learning as I do some corporate wealth management for many people across Canada. And what I'm finding is that those who are heavily involved in real estate are all fairly cash flow poor, right? And I'm sure we're at a the worst point right now, right, with these interest rates being so high. But it just made me sort of think to myself that, at some point in the future, I should probably have something to mitigate that risk, because when you need money, everybody else probably will need money. And that's obviously not a good place to be in. So, a couple thoughts there, not that we actually did something different, but maybe something that, others can learn from here as, we hope to start another cycle, and we will eventually hit that place again where rates eventually go back up again after they come back down.
Yeah, I do agree with you. I think rates are going to start coming back down. I don't know if it's going to be June or at some point,
Yeah.
but I think we're almost through the worst of it. And And like you, I always wanted to keep every single property, but sometimes selling to be able to acquire or to just have a buffer, one or two or whatnot in the portfolio is a great option. Now you also mentioned going into the US again, potentially. And it's something that, for the longest time I wasn't really looking at it. I'm starting to look at it more and more. Because I think there's some opportunity. I think there's some additional financing that we have access to now that we may not have had access to in the past, for Canadians. But also, looking at like what happened in the last 2, 3, 4 years. And to be honest, for me, it's also the government and the control that they are having over.
Yeah.
And I think a lot of, like, probably since 2021, I want to say that, the taxes, and I mean, you're a math guy and we talked about tax, but I think they're starting to really come after investors and landlords more and more. And it feels like they're, starting to really put in, an eyeglass over everything that we're doing with all the requirements that they're asking us to now start declaring. And I want to do real estate for my control over myself. And so I feel like we're starting to be controlled a little bit more. I don't love where this country is going right now. I think, change of government would be great down the road, but this is not a political show. However, now it opens the door to, do I want everything in Canada all the time?
Yeah.
Or should some money be moved somewhere else? And, what does that look like? So what are your thoughts?
I 100% agree with you. I have no, I think there's some others out there that are very, I guess vocal about it, that, they want to take everything they have here and sell it all and go there. Like, I'm not thinking along those lines, but I am thinking from like a diversification standpoint, and it sounds like you're thinking the same. I also think about currency risk as well, right? And I think about, again, I don't think the US is in great shape when it comes to, their economic policies and, where the Fed's taken things and so forth. They've obviously made some mistakes, and we've kind of followed along and maybe gone more extreme in terms of the money printing. But it definitely makes you think that if you build more property and you diversify, you get obviously the investment perspective from diversification. If, let's say, I've got a lot of doors here in Windsor, Essex, if our market, sort of has a rough spot moving forward. Actually, we're kind of like one of the maybe glimmers of hope with the battery plant coming and, the Gordie Howe Bridge. We have a lot of things going on. So that's positive, but could also go the other way, where we go into a scenario where maybe EVs aren't, the thing that everyone thought they were going to be, and maybe that plant closes down. So I like the idea of, I still want real estate, but if you can be a little bit more strategic about where you're buying, I'm not suggesting, hey, we go and buy everything in, Cleveland, Ohio, but rather you might do some research there, maybe find a property or two you like there. Of course, you want to make it, in that case, I think the sacrifice you're likely making, unless you find the right people, is I might lose that margin of safety off the bat, and I might be just looking more for cash flow. But again, that's the play, the diversification that we're looking for. Maybe that's okay. And I just like the idea that, hey, if I own enough property here and I own enough property there, it just gives you more opportunities later. I have this vision in my mind. My wife doesn't like this vision, but my vision in my mind is, at some point I could sell a property in the US. I still have a property in Phoenix that we rent full time. We sold the one in Florida back when we were building our primary residence here. And, I have this idea in my mind that, hey, if we have enough property in the US, we might sell one or two or whatever and buy a nice vacation spot somewhere when we're ready. My wife hates that idea, but it's still in my mind as an idea. She'd rather just hop around and, go travel and do things together that way. So for me, diversification, currency risk, again, when the US dollar is really strong, like it is right now, cash flow in the US is obviously a benefit, especially if you want to travel in the US, and then vice versa. If, things go back to even at some point down the road, then, hey, your cash flow over here is helping you deal with, that currency risk in the US.
Yeah, I do agree. And I think that, for Canada, like they like the multifamily, the new unit builds, the CMHC with the MLI Select. I feel like they're really pushing that kind of stuff. But if you were to be brand new and starting and buying a single family, like for now, my thoughts are those times are probably not quite there again yet. They were
Right.
there back in the day, but I think now it's multifamily, creating new units. Like I still think that there's tons of opportunities. Like we're still in the process of finishing, many units. But I don't personally, like I wouldn't buy a single family. I probably still wouldn't buy a duplex. That's just me at this point
Yep.
where I am. I just don't see, the upside. But would I consider doing something like that in the US and making it a short-term or mid-term rental? Potentially.
Yeah, for
Um,
sure.
but I think it's going to be interesting to see what happens when the rates come down, right? And what the next year and a half before the elections come. The US elections are happening. I think we're going to start seeing a lot of changes. Um, are you doing anything to be prepared maybe for acquisitions? Like, are you like ensuring that you have cash handy? Like, what are you doing in that aspect?
We definitely have cash handy, and I think it really makes us think twice before we say yes to a deal. So we had a couple deals come through in November. So we had a single family, but again, it was a very special case, a lot of equity built into this property. Same thing with the duplex. It was a special case. So it just, those ones just made sense. It was like, yep, these make sense. Let's do those. But we certainly aren't looking at what's out there and going, like, let's just put all this capital to use, because I think you're right. I think we are going to see, who knows when we can have bets on when that first rate cut comes, right? And a month ago, hey, inflation numbers were looking great, everything's under control, and then the most recent here, we're recording this in March, the most recent suggests that now they're hotter than we thought. So what does that mean? And with the election in the US, like all of these things are really hard for us to know what's going to happen. But I have a funny feeling, a sneaky suspicion, if history sort of doesn't repeat, but it definitely rhymes. We look back and once those rates sort of stay flat for a little while, as they have been for the last little while here, there's going to be a point where the trailing data will be too late before the Fed and before the Bank of Canada can actually respond to it. So they're reading data that has happened months ago. And that's not what's happening today in the economy. So usually what happens is that once the numbers are already bad, they have to make changes, and usually they're pretty aggressive.
Quick,
So
yeah.
is it July? Is it, later this fall? Whenever it happens, we're probably not going to see like a single rate cut and then it just holds for another 6 months. It's probably going to be sort of, a bit of an escalator down. Maybe
Yeah.
not the elevator, but an escalator that's going to try to, save things from breaking the economy completely.
Yeah, no, absolutely. I think having some cash on hand is going to be important. A, to take
Mhm.
advantage of some opportunities, but B, to, make sure that your portfolio stays and as you're, going through this, I think there's going to be, I mean, obviously they're going to have to reduce it, but I think there's going to be a lot more demand for rents at some point, because this is just, again, my own speculation as we're talking about just, thoughts and stuff like that. But
Mhm.
people are not going to be able to afford their mortgages as soon as they start coming due, depending on what the rates are going to be. So I think some people are going to start selling quickly, and then they're going to be renting or they're going to be downsizing. So we'll see what happens. But I think the rental market will likely get, better, because it's been really soft. I don't know if you've tried to
Totally.
rent and what it looks like out where you are, but in Hamilton and Welland and in those areas, before we used to be able to fill them like within a month. And so now it's taking a lot longer, and the basement units aren't doing as well. We've had to drop some prices, do some incentives. It's a very, very different rental market right now. Again, I'm not saying this is for everything. If you've got a
Sure.
property in South Oakville or something and it's the only one, it'd be different. But it's just been a different rental market. And I think people are just staying put because they can no longer afford those higher rents with the higher food costs and everything like that. But I think we're going to start seeing that go back up, once rates start coming back down.
For sure. For sure. Yeah. I think it's definitely one of those scenarios where, hey, if there is a housing shortage, we know that, and yet, we're having some of these problems. So something's going to obviously have to change, right? So,
Mhm.
we'll see. And like you say, I think having yourself in a position that, you're not over leveraged, you're not cash flow poor, will at least get you through that bump. And then the next opportunity will arrive. We just don't know exactly when that will be, but you certainly want to be ready for it.
Absolutely. So when did you leave your full-time job if you've left? Have you left? I think you already told me before the show, so I kind of gave it away, but so walk me through or walk us through how that all happened.
Well, for me, this is like a whole other rabbit hole, but I've been a serial entrepreneur for, over a decade. So had a consulting business with another business partner. So he's sort of handling that side of things right now. And then we had the real estate portfolio with my other partner, Matt. And we'd been doing that for, like I said, over a decade. And I loved my job, as a teacher. I love helping. I love teaching and educating. And, I just got to a point where, my wife was saying to me, she's like, like you're trying to do all of these different things because you're passionate about all of them. She's like, why don't you just like try it out? Like see what that'll look like and sound like. So
Mhm.
took some time away. So this would have been, I don't know what, 18 months, 18 months ago or so, just to kind of do full-time work because I was kind of doing two full-time jobs.
Mhm.
In the evenings I was doing all of this other work. And it just made me realize and recognize that I'm like, I felt sort of defined as I am a high school math teacher and I became a consultant for our local district. So it was like, I am the math guy. And in reality, I'm like, that's actually not who I am. I'm a guy that likes educating. I'm a guy that loves numbers. I'm a guy that loves I like all of these things. And I'm like, I wonder what that would look like in a different world. So I've really been focusing a lot of my time and energy on, corporate wealth management strategies, because I spent about a decade learning about it myself, trying to figure out how do we navigate, when you get to a place where you have success inside a corporation,
Mhm.
when people open a corporation, they're like, I just need to focus on my business. If it's an active business or passive real estate, they're like, I just need to get to success. And then it's like, once they get there, or they're very close to getting there, they start to recognize that, oh my gosh, I just created success instead of a jail. And I need
Mhm.
to somehow get this out because it's very punitive if you don't. And that's kind of what I focused a lot of time on, just trying to figure out how do we solve this problem for ourselves. And there was really no one out there. There was, one particular individual that I now work with, was doing this type of work. And I was like, I want to go all in on this. And that's kind of the work that I do day to day right now. And I love it because I get to teach people. I
Mhm.
get to help them solve problems that I was dealing with and currently deal with as an entrepreneur and an investor.
Mhm.
And ultimately, at the end of the day, one advantage is, hey, kids falling asleep in a math class, you're not getting someone falling asleep when they're learning about how they can keep more of their money instead of potentially losing half of it when the government taxes them, be it
Mhm.
taking it out personally or, hey, upon death when, when they have to tax the estate.
Mhm. Yeah, no, absolutely. So how do you find a lot of your clients right now, the corporate clients? Are they coming to you or are you reaching out to them?
You know what? It's a little bit of both. Like we have a podcast. Hopefully, it's okay if I name drop the
Mhm.
podcast. Is called Canadian Wealth Secrets, and really, it's designed to help anyone out there that has sort of an entrepreneurial spirit. However, we focus a lot of our strategies around helping those who are investing in real estate, especially if they have a corporation or active businesses. We
Mhm.
just try to help them become aware of some of the things that might be working against them that they're unaware of. So, for example, when I opened my corporation over, 12 years ago, I thought that I was getting a lower tax rate. But in reality, I just realized that, oh my gosh, I'm now any passive income that is net after all my expenses in the corp is like getting taxed at 50%. Like that's something that a
Mhm.
lot of people don't think about when they open up a corporation. Other things are, helpful. You can get lending a little easier as a corporation. You can do, some of those things, but there's a lot of drawbacks to it. So just really trying to help people understand, like, is now the time to incorporate? Do you not? If you have an active business, like, should you be taking all the money out and stuffing an RSP, taking it from one jail, putting it in another? Or should I be doing something different? And for us, the answer usually is something different, which is sad because it's not the typical advice that people are getting from, say, an accountant or, other financial planners. So that's really what we're trying to help people with. So the Canadian Wealth Secrets podcast is a nice way for people to kind of, learn about some of the things that you probably didn't have the time or energy to go and research yourself, and to give you some ideas that you can at least ask your accountant, or you can reach out to us, and, we'd be more than happy to kind of walk you through your scenario.
That is awesome. So on that note, what is the best way for people to reach out and find out more? So let's just go through the podcast again, and then where they can find it, and then just whatever other ways to reach out.
For sure. Yeah. Canadian Wealth Secrets is the podcast, a big red cover. It's focused all in Canada. However, some of the things are available for the US friends as well. CanadianWealthSecrets.com is probably the best place. We got a little, contact button. We're on social media. Just search Canadian Wealth Secrets, and we love interacting with people on all social media. So anything we can do to help other entrepreneurs and investors along, reach out and we'll do our best.
Amazing. Kyle, thank you so much for being on the show. It was a pleasure having you on, and thanks for sharing your story.
Awesome. Thanks so much, Sarah. I appreciate you.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larbi. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?